Are you thinking about buying a business or maybe selling the one you've built with your own two hands? If you're using an SBA 7A loan to make it happen, you've got to know the rules around what the SBA calls a change of ownership. If you don't get these right, your deal could fall apart fast. But don't worry, I'm going to break it down step by step so you can move forward with total confidence. Let's jump in. A change of ownership under the SBA 7A loan program happens when control of the business changes hands. This could mean you're buying 100% of the business, one partner is buying out the other, or someone is selling their stake to a new owner. Rule number 1. The SBA requires that the buyer ends up with 100% ownership at the end of the transaction. No ifs, no buts. Partial buyouts are not eligible under the 7A program. Rule number 2. The buyer needs experience. The SBA wants to make sure the person taking over knows what they're doing. You don't need to be an expert, but you should have relevant management or industry experience, especially if you're running the business day to day. Rule number 3. The business must cash flow. This one's huge. The business must generate enough cash flow to pay the loan. Even if you have amazing credit and a strong down payment, if the business isn't making money, the SBA won't approve it. Rule number 4. The seller must fully exit the ownership. Once the deal closes, the seller must step out of the ownership role completely. They can stay on temporarily for training, usually 30 to 90 days, but they cannot keep shares or any control over the business. Rule number 5. Business valuation is required. SBA lenders are required to get a third-party business valuation. This ensures the price you're paying and the amount you're borrowing makes sense. A pro tip: the valuation can affect how much you're allowed to borrow. So yeah, it's not just paperwork, it's critical to your deal. Here's the good news. SBA loans can cover more than just the purchase price. You can also roll in working capital, equipment, closing costs, and even some inventory if it's part of the sale. Before we wrap up, let's talk about deal killers to avoid. If the seller wants to stay in control, if you're only buying part of the business, if the business doesn't cash flow, or you're not ready to run it. If any of those apply, pause. Talk to a lender first. Buying a business with an SBA 7A loan can be one of the best ways to build wealth if you follow the rules. So before you sign anything, make sure you're buying 100% of the company, the business is solid, and you're ready to take the reins. I hope this video helped the SBA change of ownership rules super clear. If it did, hit that like button, subscribe, and ring the bell. I post weekly tips on SBA loans, funding strategies, and how to grow smart. Until next time, class dismissed.